Welcome to Spreadsheet Geek. In this video, we'll take a look at stock market corrections. Specifically, we'll consider the likelihood of a 10% stock market correction in the 12 months following a new all-time high for the stock market. This video was made using Microsoft Excel 2019. For the purposes of this video, we will consider the stock market to be the S&P 500 index. I realize the S&P 500 only makes up 80% of the US stock market and a much smaller percentage of the global stock market. I would rather use a broader index, but the S&P 500 is the index that has data readily available on places such as Yahoo. You go to historical data here, and you used to be able to actually download this data. Fortunately, I downloaded it a while back and kept a copy. Nowadays, if you do that, you have to update kind of manually by doing this sort of copy and paste operation into an Excel worksheet. So here's my Excel file with daily data for the S&P 500 index. This data starts on December 30th, 1927. And let's go ahead and freeze those panes so I can keep the headers. We'll scroll down to the bottom. And I've updated my file with the latest dates. Today is July 22nd, 2021. So I've got all the closing, open, low, high data from 1927 through yesterday. Now this adjusted close column is something I'm going to actually delete in this exercise. Normally on Yahoo, the adjusted close data reflects immediate reinvestment of dividend distributions. For a normal company that has dividends, or an index I suppose, this first number here would be much lower than the close. And as the data continues down to the bottom, you would have two numbers that are the same. So you could actually plot total return using the adjusted close data. However, on Yahoo with the S&P 500 index, you don't get any dividend data. These numbers are the same in both columns, so I'm going to delete this adjusted close column. It's just a distractor. And I'm also going to ignore the open, high, and low for each day. And we will consider only record closing prices for the index to be a record close. So just to revisit what we're trying to do here, we would like to identify all the days in this entire column where the S&P 500 index hit a new all-time high. And for those days, and those days only, I want to know how often a 10% correction occurred in the next 12 months after each of these days. So in order to do that, we're going to have to identify all the days where the market made a new high. So this is a relatively easy task. Let's paste in a name here. We'll call it new high, and I'll put a question mark after that. So what I'm going to do is make a 1 appear in this column, and I'm doing that for reasons you'll see later. But anytime the market hits a new all-time high, there will be a 1 in this column. So this first date of December 30th, 1927, there's really nothing to compare prior to that. For our purposes, that's the beginning of the stock market, even though it really wasn't. We'll go to this second date and we'll put in an if function. And that'll say if the value in this cell, the closing price on January 3rd, 1928, is greater than the max of all numbers prior to that, which would be B2 through B2 in this case, then show me a 1. Otherwise, show me a blank cell. So that gives us a 1, which makes sense because this close is higher than this close. Now I want to make one change to this before I autofill it down all the way to the bottom, and that is that I want to fix this reference here, make it an absolute. So this first B2, I'm going to hit the F4 to put the question marks around that. And I want the B2 here to be a relative reference. So every time I paste this formula down a little further, that will always reflect the cell just to the left. So let's go ahead and autofill that down and see what we get. So you'll notice in this cell, the relative reference advanced to B3, it goes to B4 here, B5, but B2 always remains the same. Now let's see if this makes sense. We have an all-time new high here, and we'll go down until we see another one. There's a 17.93. I don't see any numbers any higher than that up here this way. So it looks like our new high formula is working. So I'm going to scroll down to the very bottom, and what I'd like to do is sum up all of those numbers. So that'll go from C2, accounting for the header, through this cell of 23,501. Let's see how many new highs in the history of the stock market. So out of 23,500 trading days, there have been about 1,200 new highs. Let's take a simple percentage and convert that to a percentage. I'm just going to type this in manually, 23,500. That's about 5.5% of all days. So 5.5% of all trading days since the end of 1927 have been all-time new high days for the S&P 500 index. I didn't really have any preconceived notions about what that number would be, but it seems like a reasonable answer. Now, if we scroll back up to the top, we can make kind of a casual observation here, and that is that these new high days are kind of, they tend to be clustered together in groups. There's a cluster here, and we'll get into 1929. There's a long cluster of them, and that was a very famous market top around October or so, where we had a long run. And then there'll be a long period of drought where there are no new highs. This behavior tends to repeat itself over time. I'm going to scroll down into the 60s, and you see a drought there followed by some little clusters of new highs as we move into other periods of time. So that's kind of the nature of the stock market. It will move up and rally for some period of time and then correct or go sideways for a period of time. So I've created a new column, column D, and this is the column where we're going to identify for each new high whether or not a correction of a certain percentage occurred in the subsequent 12 months. For right now, let's just make that 10%. We're looking for 10% corrections in the subsequent 12 months. One thing I need to point out before we go any further is that these dates are not complete. You'll notice that the January 7th and 8th are missing in between here because that's a weekend. So these dates only reflect trading days. And I did a little legwork offline and went through a sampling of all the years. And what I found is that there's typically 251 trading days in a year, give or take one or two. But for our purposes, I'm going to use 251 trading days for each year. Now I don't have anything here, so it makes sense to gray out this cell and go down to the next one before we start this. So what are my two conditions? I'm going to have an if, and I'm going to nest an and statement within that. So in an and function, everything's got to be true. And my conditions are that this cell must equal exactly 1, and I'll separate these conditions with a comma. The second condition is that the min of B5 through B256. Remember, we said we have 251 trading days in the subsequent trading year. So that 5 to 256 gives me 251. So the minimum close that occurs during that period, if that is less than or equal to, and here's where we get our percentage, we'll go 1 minus this percentage, so that would be 90%. And I'm going to fix this reference here to make it absolute so that never moves. If 90% of B4. So if those two conditions are true, I want to see a 1. Otherwise, show me a blank cell. Let's go over that one more time. If this cell is equal to 1 and the minimum of the next 251 trading days is less than or equal to, that's a fine line, 90% of B4, that would be a valid correction, and we should get a 1 here, a correction of 10%. So let's go ahead and autofill that one down. So I went down to the bottom and I fixed up these headers a little bit. I have our new all-time highs. We had that before, and the percent of trading days was, divided by 23,500. So that was 5.5%. Now I'm going to sum up this column over here. Those are our corrections. And let's make sure we get this right because of the way that formula is written. We'll make this D3. So we have 371 valid 10% corrections. Now some of those corrections are the same correction, but we have 371 cases out of the 1,289 where a 10% correction occurred within 12 months. So let's find the percentage of corrections. Let's go with this number divided by this number, and we'll get a percentage of, looks like about 29%. So for every day the stock market hit a new all-time high, there was a 29% likelihood that a correction of 10% or more would occur within the 12 months following. Now, because of the way we set up our spreadsheet, we can alter this cell right here. I can make that 20%. I can look only for 20% corrections that occurred. I would expect this number to drop and this number to drop as well. Let's try that. So for every time the S&P 500 hit a new all-time high, a 20% correction occurred only about 15% of the time, or 189 out of 1,289 opportunities, we'll call them. What about a 5% correction? I would expect those to be very common. So yes, let's consider that almost half the time a 5% correction will occur within 12 months after the stock market hits a new all-time high. There is a slight problem I will point out with the most recent dates. If you go back to July of 2020, you'll see some new highs and you'll see some corrections that have already occurred even though it's been less than a year. But when you get down into November, December of 2020, and keep in mind it's July of 2021 right now, we have some new highs, but we don't really know what's going to happen over here yet because these functions effectively haven't timed out yet. This one goes down to row 23,584, and we're not there yet. So it's yet to be seen what's going to happen there. So that is making our percentages possibly appear to be a little bit low. And I'm talking about this number here, this number and this percentage. This could actually be a little bit higher once we find out what's going to happen, and this denominator will not move any higher. So keep that in mind. Another observation is that if you scroll down through the days, this pattern that occurred in 2016 is fairly typical. There was nothing going on prior to about July 2016 in terms of new highs for the index, but then it did hit a new high in July, and there was a string of new highs, a waiting period, some more strings of new highs, and eventually it got to a point where we did have a correction phase come in. So that's kind of a pattern that tends to repeat itself over and over again if you scroll through the long history of the index. If I were going to repeat this exercise over again, I might do it on a monthly basis. This is a little deceptive because it's not 371 corrections. Many of those are basically the same correction. And the new highs, you could say the same thing about those. So if you did this on a monthly basis, it might in fact make a little more sense, but I would use the same general technique. Some recent research has concluded that if you have a lump sum to invest right now and the market is making new highs, you're better off just putting the entire lump sum in if that's your eventual intention to do that anyway. That would be a smarter move than dollar cost averaging in or waiting for some sort of correction of a certain amount. This little exercise we've done here would seem to support that idea. I've summarized the findings of this video in this table. I encourage you to pause the video here and take a look at these numbers. The overall conclusion is that when the S&P 500 historically has reached an all-time daily closing high, it's been somewhat unlikely to observe significant pullbacks within the subsequent 12 months. It does occur, and you should be psychologically prepared for it if you're an index investor, but it is fairly uncommon. I hope you found this little exercise interesting and informative. Please consider subscribing to my channel, sharing my videos with others, or just giving me a thumbs up. I'd also appreciate your comments if you'd like a certain topic covered. Thank you for visiting Spreadsheet Geek.